Hello dear students, myself CMA Padmaja Buzruk. I will discuss fundamentals of accounting. Please go to study note number 1 of group 1 paper 5. I will discuss basics of accounting. There are various types of businesses like sole proprietorship firm, partnership firm, joint stock companies. But objective of most of these businesses is to earn profit and to maximize the wealth for owners. Success of any kind of this business depends upon how efficiently and effectively various resources are used. Business activities require resources. They are limited, scarce, but they are having multiple uses. These resources are main material, machines, factories, various services. And success of business depends on how efficiently and effectively these resources are used. The result of business operations will be either profit or loss. Business owner is interested in finding out whether he has earned profit or suffered a loss. And he is also interested, business owner is interested in knowing the financial position of the business. That is, assets and liabilities of the business, what the owner owes to others, and what he himself owns. To know correct profit and loss and correct financial position of the business, recording of business activities has to be done in scientific manner. Field of accounting is subdivided into bookkeeping, financial accounting, cost accounting, and management accounting. These are also known as branches of accounting. So one by one we'll see all these various branches of accounting. First is bookkeeping. Definition of bookkeeping given by J.R. Botley is bookkeeping is an art of recording business transactions in a set of books. So in short, recording of various business transactions in the books of accounts is bookkeeping. Now, what are these business transactions? These can be purchase of goods, sale of goods, payment of expenses, receipt of money, etc. And these transactions to be recorded in various books. So, which are these books? These various books are journal, ledger, cash and bank book, subsidiary books, etc. Subsidiary books are purchase day book, sales day book, return inward book, return outward book, bills receivable book, bills payable book. Even cash book comes under subsidiary books. What are the various features of bookkeeping that we'll see now? Bookkeeping is basically a record keeping function. Just now we have seen bookkeeping is nothing but recording various business transactions in the books of accounts. In various books of accounts, these transactions are recorded, and only transactions which are expressed in terms of money only are recorded in books of accounts. It is a continuous activity. Each and every transaction gets recorded timely in chronological order, that is date wise. Records are being maintained as transactions are entered into. Few more features of bookkeeping. Bookkeeping is routine and repetitive work, but nowadays it is taken over by computer systems. Many accounting packages are available depending upon needs of various business organizations. Various accounting packages are available and the organization can select depending upon its own requirement. Bookkeeping is also referred to as set of primary records. These records form basis for accounting, that is, financial statements, profit and loss account and balance sheet are prepared using these primary records. Bookkeeping is an art. These are various features of bookkeeping. Now we'll see what is financial accounting. Definition of financial accounting is given by American Institute of Certified Public Accountants. As per this, financial accounting is an art of recording, classifying, and summarizing in a significant manner and in terms of money, transactions, and events which are in part at least of financial character and interpreting the results thereof. So, in short, what is given here? Recording of business transactions in significant manner, only monetary transactions, transactions expressed in terms of money only are recorded. And why it is recorded? In order to find the result thereof, that is to find profit and loss, or profit or loss. Two important financial statements are prepared. They are profit and loss account and balance sheet. Financial accounting is sometimes referred only as accounting. Various features of financial accounting we'll see one by one. First is, it is commonly termed as accounting. Transactions which have financial impact are only recorded in the books of accounts. That means, supposing if a businessman negotiate with customer regarding supply of product, this will not be recorded. The negotiation is deal which will potentially create a transaction and will have exchange of money or money's worth. But unless the transaction is finally entered into, it will not be recorded in the books of accounts. Few more features of financial accounting. Recording of business transactions is based on golden rules of accounting in a systematic manner. Accounts are classified into personal and impersonal accounts. Impersonal accounts are classified into real and nominal accounts. And for recording transactions, excuse me, golden rules are followed. These golden rules are: for personal account, debit the receiver, credit the giver. For real account, debit what comes in, credit what goes out. And for nominal account, debit all expenses and losses and credit all incomes and gains. As transactions increase in number, to understand combined effect of the same, these transactions are summarized. Summarization will help user of the business information to understand and interpret business results. Summarization is what? Transaction of similar nature are grouped together and recorded accordingly. For example, all sales transactions, all purchase transactions, all cash transactions are grouped together, summarize. Total of this various transactions of similar type are taken, so that it will help to find out whether the business has earned profit or sustained loss. With the aid of computerization, this summarization is really simplified in today's world. Few more features of financial accounting we'll see. Financial accounting provides two important financial statements to the users, and these financial statements are profit and loss account and balance sheet. Financial accounting is science. Why? Because it is based on universally applicable set of rules. There are various rules which are to be followed while preparing accounting. So it is science. However, it is not pure science. Why? Because there is a possibility of different interpretation. There are various accounting methods available. An accountant can select from these various methods like depreciation method, method of valuation of inventory, etc. And that is the reason why you cannot call it as pure science. Next is cost accounting. Definition of cost is given by Chartered Institute of Management Accountants. Cost accountancy is defined as application of costing and cost accounting principles, methods and techniques to the science, art and practice of cost control and ascertainment of profitability as well as presentation of information for the purpose of managerial decision making. So as per this definition, cost accountancy is presentation of cost information for the purpose of managerial decision making, ascertainment of profit and for cost control. Cost sheets are prepared, and these cost sheets are prepared in cost accounting product wise, process wise, department wise, division wise as per requirement of management. In cost accounting, it is possible to get cost and product of each product, each process, each division, each department, etc. Main aim is cost reduction and cost control. Unprofitable products can get replaced by more profitable products with the help of cost accounting. In financial accounting, profit and loss account is prepared and which gives profit or loss for business as a whole. Even if the businessman is dealing with various different products, purchases and sales for all the products are recorded together. It is clubbed together, summarized, and you will get profit for business as a whole. But in case of cost accounting, it is possible to get product wise profitability. Now, one by one, we'll see various features of cost accounting. It is a branch of accounting dealing with classification, recording, allocation, summarization, and reporting of current and prospective cost and analyzing their behavior. So, cost accounting is a branch of accounting. Here also, various documentary evidences, invoices are used. Costs are classified like classification. Costs are classified like material, labor, expenses. Some common costs are distributed, apportioned among various products. Of course, totaling is done, total cost is found out, and it is used for the purpose of cost control. Cost accounting is frequently used to facilitate internal decision making and provide tool with which management can appraise performance and control cost of doing business. Cost accounting information is only for internal use. It is never revealed, never disclosed to outsiders. It is only for managerial decision making and mostly for the purpose of cost reduction and cost control. Few more features. Cost accounting is primarily involves relating to cost to different products produced and sold or services rendered by business. So whatever may be the business rendering of services or selling of the product, cost accounting is finding out cost of these different products and various services. This branch of accounting deals with process of ascertainment of cost for decision making. Cost accounting aims at equipping management with information that can be used for control on business activities. So main aim of cost accounting is provide information to the managers for making various decisions. Cost accounting uses the same financial accounting documents and records. Modern computerized accounting packages like ERP system etc. provide processing of financial as well as cost accounting records simultaneously. Next branch of accounting is management accounting. We'll see definition which is given by Chartered Institute of Management Accountants. Management accounting is the process of identification, measurement, accumulation, analysis, preparation, interpretation, and communication of information used by management to plan, evaluate, and control within an entity and to assure appropriate use of and accountability for its resources. Management accounting also comprises the preparation of financial reports for non-management groups such as shareholders, creditors, regulatory authorities, and tax authorities. Management accounting is providing accounting information for discharge of various managerial functions. That is, providing accounting information to managers for discharging various managerial functions like planning, organizing, coordinating, control, etc. So, management accounting uses financial accounting information as well as cost accounting information. It also prepares reports for non-management groups. We have seen just now these groups like shareholders, creditors, tax authorities, etc. So, management accounting is nothing but providing financial and cost accounting information to managers for discharging various managerial functions like planning, organizing, coordinating, control, decision making, etc. Now we'll see few features of management accounting. Management accounting aims to facilitate management in formulating strategies, planning, and constructing business activities, making decisions, optimal use of resources, and safeguarding assets of business. So, for formulation of strategies, for planning, for various business activities, for making decisions, for optimum use of resources, for safeguarding of business assets, management managers need various accounting information, and aim of management accounting is to provide this information to the managers. Few more features we'll see. Management accounting uses financial and cost accounting information for making business decisions that would help managers in their management and control functions. Unlike financial accounting information, management accounting information is used within an organization and is used usually confidential, and its access available only to selected few. So this is applicable to cost accounting also. Financial accounting information is disclosed, revealed to outsiders, whereas cost accounting and management accounting information is used within the organization. It is confidential and its access is not available to outsiders. Now we'll see distinction between bookkeeping and accounting, which is given in your book. Bookkeeping is considered as end and accounting is considered as beginning. So in short, it is accounting starts when bookkeeping ends. Function is the second distinction. The primary stage of accounting function is called bookkeeping. The overall accounting function are guided by accountancy. So in short, we'll see what are the functions differently. Bookkeeping deals with identifying and recording financial transactions, whereas Accounting summarizes, interprets, and communicates financial data. So, in bookkeeping, only transactions are recorded in the books of accounts, and in accounting, financial statement, profit and loss account, and balance sheet is prepared. Next distinction, bookkeeping can provide base of accounting, and accountancy depends on bookkeeping for its complete functions. So, in short, bookkeeping is a set of primary records which is prepared using various source documents, that is vouchers, whereas accountancy or accounting is based on bookkeeping. Next distinction, excuse me. The necessary data about financial performances and financial positions are taken from bookkeeping. Financial performance is given by profit and loss account. Financial position is given by balance sheet. For preparation of these statements, necessary data is taken from bookkeeping. Accountancy can take its decisions, prepare reports, statements from the data taken from bookkeeping. So, in short, data provided by bookkeeping is not sufficient for decision making, whereas various managerial decisions are based on data obtained from accounting. Next and last distinction, financial transactions are recorded on the basis of accounting principle, concepts, and conventions. Accountancy does not take any principles, concepts, and conventions from bookkeeping. So, for recording transactions in the books of accounts, various cost accounting principles, concepts, and conventions are used. Whereas financial statements, profit and loss account and balance sheet, and various financial reports are prepared from bookkeeping data. So, few more distinctions also you can add here. Bookkeeping does not show financial position of a business or financial reports results of a business, whereas accounting helps in showing financial results and financial position of a business. Person concerned with bookkeeping is known as bookkeeper. Person concerned with accounting is known as accountant. No high level of learning is required in bookkeeping because it is a repetitive clerical job, whereas high level of learning is required for understanding and analyzing accounting concepts. Now we'll see distinction between management accounting and financial accounting. Management accounting is primarily based on data available from financial accounting. Financial accounting is based on monetary transactions of the business. So, in short, management accounting uses financial accounting and cost accounting information, whereas financial accounting is based on bookkeeping. Next distinction, management accounting provides necessary information to the management to assist them in the process of planning, controlling, performance evaluation, and decision making. Financial accounting main focus is on recording and classifying monetary transactions in the books of accounts and preparation of financial statement at the end of accounting period. So, in short, it is management accounting provides information to the managers for discharging various managerial functions, whereas financial accounting main focus is preparation of financial statements. Next distinction, reports prepared in management accounting are meant for management and as per management requirement. Financial accounting reports are meant for management as well as for shareholders and creditors. So, in short, what is given here? Management accounting reports are for internal use, they are for internal users like directors, managers, employees, whereas financial accounting reports are for Various stakeholders like shareholders, creditors, lenders, bank. Of course, they are also for internal users like managers. Next distinction, report may contain subjective and objective figures in management accounting, whereas report should always be supported by relevant figures, and it emphasizes on objectivity of data in financial accounting. So in short, management accounting reports can be subjective, that is, they are based on manager's judgment, whereas financial accounting reports are based on facts and figures only, and hence they are always objective. Next point, reports are not subject to statutory audit, and reports are always subject to statutory audit. So in short, it is management accounting information is not disclosed. It is only for managers. It is for internal purpose. So it is not subject to statutory audit. Whereas financial statements are subject to statutory audit. Next distinction. Management accounting evaluates the sectional as well as entire performance of the business. Financial accounting ascertains, evaluates, and exhibits financial strength of the whole business. So, management accounting is focused on segment reporting, that is, reporting only particular segment of organization, whereas financial accounting is for business as a whole. So, you can add one more distinction like management accounting reports are prepared whenever need arises as per requirement of management, whereas financial statements are prepared at the year end. And for financial statements, accounting period of 12 months is used, whereas management accounting report period depends upon requirement of managers. Now we'll see accounting cycle. When transactions enter into the business, they are recorded in the books of accounts. This recording takes place in various books of accounts like journal, subsidiary book, and from journal and subsidiary book it gets posted to ledger. Then trial balance is prepared. There are various adjustment entries. These adjustment entries are passed like prepaid expenses, outstanding expenses, depreciation, etc. Sometimes adjusted trial balance is also prepared. Then closing journal entries are passed. At the end of the year, nominal accounts, that is accounts of income, expenditure, losses and gains are closed by transferring it to profit and loss account. These are known as closing entries. Once closing entries are passed, financial statements are prepared, profit and loss account and balance sheet. Then again, next year, same procedure keeps on repeating, and that is known as accounting cycle. Every year, nominal accounts get closed by transferring it to profit and loss account, but real and personal accounts are get transferred to the next accounting period. There are various steps and phases of accounting cycle. We'll see one by one. Recording of transactions. First is the first step. As soon as the transaction takes place, it is recorded in subsidiary books. We have seen various subsidiary books like purchase day book, sales day book, cash book, return inward book, return outward book, bills receivable book, bills payable book, etc. Next is journal. Transactions are recorded in journal in a date wise, that is chronologically. Once transactions are recorded in journal or subsidiary book, then it gets transferred to ledger. Then ledger accounts at the year end are closed, that is balanced. It is a process of taking total of both the columns and finding out the balance difference between the total of debit and credit column, that is known as balancing of the ledger. Once ledgers are balanced, trial balance is prepared. Trial balance should match. Debit total of trial balance should be equal to credit total of trial balance. Then adjustment entries are passed. I have told you there are various adjustment entries like outstanding expenses, prepaid expenses, depreciation, etc. Sometimes adjustment trial balance is also prepared after adjustment entries are passed. Then closing entries are passed. All nominal accounts are closed by transferring it to trading profit and loss account by passing closing entries. And then at the end financial statements are prepared. Financial statements are profit and loss account and balance sheet. These are various steps or phases of accounting cycle. In this particular video, I have discussed about branches of accounting, definition, meaning and features of branches of accounting, distinction between bookkeeping and accountancy, management accounting and financial accounting, and we have seen what is accounting cycle and phases of accounting cycle. Thank you.